All right, now, first of all, benefit of break-even analysis. All right, say if you what's important of this lesson. All right, first you can do a smart pricing. Okay, so when you just say you start your business, say you are, of course, without any product, you cannot start any business. So when you just pricing your product, so you know what the minimum amount you need to be set, okay, in order to sell the price. You cannot you set the price, too much, because that could be, imbalance, as we said, right? Some people, they're selling less than that. So say if you quote that the price, this could be you not have any demand. So the people, the customers not interested anymore to buy things with you. Okay, so smart pricing, so one of that important part. Next is a better decision making. Okay, that is a make you to make a better decision in order to make your good. It can be trade in that the market. Next, figure out missing expenses. So you easily can able to find out, okay, or figure out what of those missing expenses you need to consider. Okay. Next is a plan for the business funding. Just now, Najmi said, strategize. Okay, the business. So you need to plan the business funding. How are we going to fund your business? And then next is set revenue and sales target. Okay, you know how much the revenue you are look for in your business, and then you need to set your target. Okay, how much the sales are going to do in this month? Okay, that is very useful after once you just know how to use that break-even analysis. Okay, next, meeting that cost point. Okay, the fixed cost. So meeting the fixed cost means you know what that the cost of the product that you're going to sell. Okay, most of the you, I mean, most of the trade in the businesses, they failure because they don't know how to fix the price. They always vary. Okay, not the appropriate price that what they supposed to. Okay, in that sense, they lost their business. Okay, so meeting the fixed cost is one of the crucial in that break-even analysis. Okay, now, right, in the introduction, so we're going to look into that. All right, what of those things in the break-even analysis? So this is a part of financial plan, business industry. For example, in investment plan, liquidity plans, earning plans, as well as risk analysis. Okay, this is one of the crucial parts. So what the break-even analysis is useful for. Next, you're gonna use to find the number of output and its price where no profit and no loss incurred. So they call a break-even point. So which means, so whatever you invested, all right, say your business going to be failure for some reason, but however you not intend to lose your money, right? So you know how to set that the price and the sales in order to get return whatever you spend in your business. So that we call break-even point. Okay, so once you get the break-even point price or the value, so you are not even your earning a profit, but at least you can you not lost anything out of your business. Okay, so in break-even point, mainly the elements involved is a total cost, and then total variable cost, total revenue. Okay, they give that all this short form. The total cost is a TC. Total variable cost is usually they will VC or total TVC. All right, is depend on the questions and some problems. And then fixed cost, total revenue is a TR, and then the total fixed cost is a FC. So these are very common in use in that break-even analysis. Okay, so it comes to the two category. One is a linear cases, okay, another is a non-linear cases. All right, so linear cases is pretty easy. It's come up with some assumption. Okay, all right. It also can be used as algebraic or graphical method. So that break-even analysis can be represented by using that algebraic form as well as in the form of graphical form, like in the graph. You can use a graph in order to determine that the break-even, profit, loss, and so on. So, okay, and as well, it is need a assumption. Okay, we will look into that what sort of assumption later. Okay. So this assumption, usually we have to need to fix when it comes to linear cases. So for example, you need to focus on the product at a time. So you just only based on the product at a time. Okay. So second assumption is a constant selling price cost, which means your marginal revenue and marginal cost. Okay, it has to be constant. Okay, it cannot be unchanged. It's constant. Next, the fixed cost remain constant a long period. Okay, so you cannot change the fixed cost, over the period. You has to be is a constant. All right. So for 100 means even you after you sell your product even a 200 or 10,000, so it still remain the same price, which is $100 or 100 ringgit. Okay, so the fixed cost must be still remain the same. Okay, so this all the assumption you must carry out in order to do your proper break-even analysis. Okay, now, so in break-even analysis, all right, you should understand that. So it's used to predict future profit and losses. Okay, usually this is what we do. So after some times when your business is get better, so we're going to do that the analysis. So only the break-even analysis can be done in order to see that the profit and losses. Okay, next, we're going to predict the result of the produced product. Okay, say product, you just manufactured any product. Okay, so based on your business, what type of business you will carry out. Okay, for example, say you just produce toys. Okay, toys. Okay, you produce, you manufacture your own design of toys. Okay, and then you manufactures some luxury items. Okay, for example, gift and so on. So that is we call as a product. Mainly, you're going to do in your business. Okay, so that is the produce the product. Okay, now break-even point is when the total revenue, say all the product is you already like trades. Okay, so you get the return. All right, you already like you see that the returns. So you sell all the product and you got the amount, and then it's equal to total cost. Okay, when you reach this condition, the total TR and equal to TC, so we call it is reached break-even points. That means you'll earn any profit, but at the same time you're not lost anything based on your business that you carry out. Okay, so at this point, in the break-even point, there is no profit or loss is incurred, as I said earlier. So for example, you can be found in this type of the break-even point in the theme of like, yeah, I think some is missing. You can see this type of things in that like a rental, okay, insurance, okay. So yeah, this is all actually the sum of example, okay. Okay. In order to calculate how profitable a product will be, and you should know, firstly, we have to look into the cost involved. Okay, so this is every time you need to take into account when you do a business. So you say you're selling a product. Okay, so first you need to look into the cost involved. Say what the cost of the raw material. Okay, so we learn right in the production function. So what the production function, what the labor cost is. So you have to count everything. Okay, so once you just know that the output price, then you can start you fix that the cost, how much the actual cost is. Okay, there are two type of that, the basic type of the cost. Okay, so one is a variable cost. Okay, one is a variable cost. Another is we call as a fixed cost. Okay, so these are two basic type of cost usually they use in the company. Okay, so remember, okay, variable cost and the fixed cost. Okay, what about the variable cost? So variable cost is the changes or the changes in the production level or sales. Okay, so every time when you sell a product, the product is a variable cost. The product will change according to the quantity or number of the product is being sold. Okay, for example, the cost of material used in the production of the good. So it's it's a proportion to the number of product that is sold. Okay, the fixed cost is remain the same regardless the sales or output level. Okay, so whatever, whether the sales or not, so it still remain the same figure or same price. So that we call is a fixed cost. Okay, for example, you can see, as I said, for the rental, okay, rental, you see that sometimes the rental is fixed, right, for the rooms. All right, so the 800 means 800. Okay, so it will be constant for some times. Okay, and then insurance, so every year you paying insurance about how much, for maybe 2000s. All right, for, so it's fixed. All right, so it's not any change. As well as wages, the wages, so per hour how much you need to pay for a workers or labor. Okay, so that all is an example of the fixed cost. Okay, let's look at the profit formula. Okay, the profit formula of the product usually is indicated in the pie. So service, well, we can usually we say profit. It depends, you know, some books they refer it as a P, some books refer to the pie. Okay, all right. So this is equivalent to total revenues. Okay, TR minus total cost. Okay, total cost. So it's represent that the profit. Okay, so which means you can easily write in the algebraic form, which is profit equal to TR or total revenue minus total cost. So you can easily find how much the profit is. Okay, at the point when the profit is zero, okay, the profit is zero. So when you just move the total cost to here, so the total cost equal to the total revenue. Okay, as you can see that at the break even, the total cost, say you have no any profit, is that we call a break even. So the total cost will be, or total revenue is equal to total cost. Okay, all right. Now, next, the total cost for that time period. Okay, the total cost. Okay, the main overall cost, total cost, are the function of fixed cost per period, which is your fixed cost, unit variable cost VC. So usually we just a VC for the variable cost, as I said just earlier, and then X, the number of unit or the product to be sold. Okay, so which means you can write the total cost equal to fixed cost plus the variable cost multiplied by that number of unit which is already sold. Okay, so that is how you need to calculate that total cost. Okay, sometimes that maybe if you're not given any number of figures for that the units, so you just add these two figures, which is fixed cost plus the variable cost. Okay, at this point, any question? Is it clear?
Clear.
Clear?
Yes, doctor.
Okay, well done. All right. Next, moving on, the graphical solution method. All right, how we carry out in order to represent a graph in order to describe about all the features in the break-even analysis. Okay, all right. Now, usually this is how we need to represent that the break-even analysis. Okay, so draw a line through the origin. Okay, with the slope of product price. Okay, this is a product price. Okay, the blue line. Look at that. All right. So this is represent that the total revenue. Okay, this line represent that total revenue. Okay, so this is the price. Okay, so this is your x-axis, this is the quantity. Okay, quantity of that the goods or product. Okay, this is a quantity and this is a price. Okay, so the price. Okay, next, draw a line that intersect the vertical axis at level of fixed cost and it has a slope of MC. So that means the marginal cost. Okay, marginal cost. If you can see, this is a fixed cost. Say you just determine the fixed cost must be start from the zero product. So when the product not sell, you should to determine how much the product. Okay, so this will be the constants over the period. Okay, so this is the straight line. We call this is a fixed cost. Okay, fixed cost. Okay, so over the period, okay, so the fixed cost remain the same regardless how many number of product you sell. Okay, so see, this is like 100 and this will be 100 for any point when the product is over the period if you sell the product up to any timeline. Okay, so the TC is the total cost. Okay, the total cost, and this is the marginal cost. Okay, the changes in that the line, the red line is a total cost, is a we call as a marginal cost. Okay, all right, the intersection of TC and the TR, it's called the break-even points, which mean here. So the TC, the intersection between this point, the TC and the TR, so this point we call as a intersection point, we call as a break-even points. So which mean this all that whatever the sales we made in this section we call as a profit, and whatever you the sales made in this section we call is a deficit or losses. Okay, so you must understand this is a profit. Okay, this section is a profit, this is your losses. Okay, we go step-by-step approach. How we going to carry out this analysis in the graphical way or graphical method. Okay, guys, am I too fast?
So far, okay, doctor.
Okay.
Doctor, I have one question.
Yes, go ahead.
Can you go back to the previous slide? Okay, yeah. So
Okay.
it says that the second bullet point has a slope of MC. What does MC stands for?
Marginal cost.
Marginal cost. Okay,
Yes,
thank you.
marginal cost. Okay, marginal cost. All right. Okay, now take a look at this graph. Okay, now we have a total revenue. Okay, the green one. Okay, start from the zero value. Okay, and this output, guys, all the product represent that output quantities. Okay, and then this is our price or revenue. Okay, price or revenue. Okay, it will be calculated in the dollar or maybe RM. Okay, all right. Now we just do that analysis. How we need to carry out the analysis, step-by-step approach. Okay, as we know, the green one, the green line is to represent that the total revenue. I'm sure you all know that what does it mean, the total revenue. The number of the product we sell. Okay, number of product we sell and then we earn. Okay, earning. Okay, so earning. Total cost. Okay, as you know that variable cost and the fixed cost. So we already know that the total cost. So this is your fixed cost point. Say this has to be a straight line. Okay, fixed cost is unchanged. Okay, say if it is 100, still remain 100 over the product. Okay, or period of time, any timeline of that the product which has been sold or has been sold. Okay, so this is a total cost, and this is a variable cost. Okay, this is a variable cost. Okay, this is a variable cost. You all know variable cost. Okay, so this is the blue line. Okay, so the one it represent for the variable cost. Okay, so and this is a fixed cost. You all know, right? Okay, now say the break-even point. Okay, say the break-even point occur when the total revenue, say this for example, the total revenue equal to total cost. Okay, so the total revenue is equal to the total cost. Okay, that means here, right? Okay, this here. Okay, so look at this example. So it would have to sell the Q1, say this is a quantity, say this is a product Q1. So number of, just imagine that the Q1 is, I mean, the some numbers or some quantity of the product to generate that sufficient revenue, which means that the income to cover it all costs. So which means it has to be full year. Okay, so we call this point, we call as a break-even point. So whatever we earn at this point, all right, in this section, this cross-section, this region, so we call as a profit. Okay, and whatever we just achieved below this, the break-even point, we call losses. Okay, all right. So I told you, right? So this is a profit. Okay, this is your losses. Okay, now next. Say for example, at this present firm, they sell each unit for RM $2, 2 ringgit, sorry, RM 2 ringgit. 2 ringgit, RM 2. So the break-even point is at Q1. So at this point, so they sell that each every unit, they sell about 2 ringgit. Okay, 2 ringgit. Okay, for that the price is the 2 ringgit for the fix for each every quantity. Say if the firm chose to set the price higher than $2 or 2 ringgit. Okay, say for example, you're going to raise the price 3 ringgit. Okay, the total revenue curve would be steeper. That means it become like this. Okay, so which means initially it was the total revenue is $2. Now the firm decided to change its price to $3 per unit. So that means your line become a more steeper. Okay, more steeper. Okay, now what will happen? This firm would not have to sell as many units to find the break even. If you compare to that, when they sell the price at the $2 initially, since they increased the price to $3 now, so what happened to the quantity of product is they don't have to sell at that much. Okay, so it will become at this point now. The break even become less. So which means the number of product to be sold is become a lesser. Okay, and the firm can start look into the profit, just consider minimum number of quantity of product. Okay, so that's why it's important. You need to know how much you need to fix your price. Okay, the total cost is very important in order to fix, in order to see how much you need to set your price in order to see that the profit. Okay, so the total revenue, this is actually determined by yourself. All right, so how much you need to go and increase the price anyway. So if it is the more price, I mean the higher value, that means you will get that less number of unit in order to consider to reach break-even point. Okay, so at this point you can earn your profit easily without any problems. Okay, this become your new profit. Okay, and whatever below this point, so is your losses. Okay, so now is a new break-even point. Okay, next, say if the firm choose to set the price lower. Okay, later what happened, say the firm is decided to set the price lower, which means they no longer they're going to sell the price $2, sorry, 2 ringgit. They just want to sell, say, about 1 ringgit now. Okay, so So if you 1 ringgit, your total revenue now is become even lesser. So the slope is become less steep. Okay, it's become a lane. Okay, so it's less steeper than the one before. Okay, so if you could see that you draw the straight line, your total revenue for the one RM1, so you can see that the cross section. So the break even point is for here. Okay, your new break even point here. So that means what happened in order to see that the break even point, I mean in order to meet that break even point, so you need to sell more product, you need to sell more goods in order to see the break even price, I mean the break even point, which mean eventually, so it will take times in order to see a profit, because your profit will be moved away from that the Q3. So after you sell a number of Q3 product, then only you can see that the profit. But the profit is not much. It is a profit section. It will take times to see a profit. Okay. So, and whatever below that the break-even point, so that will be your losses. Okay, these are your losses. Is it clear, guys? Is it clear?
Yes, doctor.
Yes.
Clear, huh? All right.
Okay, doctor.
So now you can start your business. Okay. All right. Now, say any unit sold above break-even point represent the profit, as I said earlier, right? Okay. So we call it a profit. So I already told you before. This region we call profit, and same things. Whatever below that the break-even point, so we call a loss or losses. Okay. All right. So same things, the remaining. Okay. All right. In common, in the real life activity or real life, business activities. All right. We used to develop that cost volume profit chart. Okay. The chart will be in the form of like this. Okay. So it's easily can be evaluate. Okay, for your all type of the analysis. All right. Your profit, your how much you need to pay for your tax. Okay. Your total cost, your total variable cost, and your total fixed cost. Okay. So the margin of safety. Okay. So this we call a margin of safety, the one, the range, the given between this. Okay. This is a margin of safety because you earn that good amount of profit. Okay. So beyond on that, whatever you earn, that is a consider is a your good profit. I mean, it's a great profit. Okay. So this is mostly in our country. Most of people, some of businesses, they run based on the margin of safety. Okay. So margin of safety means this is just nice to run your business. If you can see the profit between this margin of safety, so you can continue your business. Otherwise, you better you stop or make some changes in your business. Is that clear?